CNBC TV 18.
Hello and welcome to the CNBC TV 18 Investment Guide. I'm Surabhi Upadhyay and with me this week is Sonia Shenoy. Sonia, it's been such an interesting ride, right? We've, drilled it down from the broader market approach to sectors. We've done chemicals, we've done pharma. And today we are going to talk about IT, guys. And there's so much of interest and excitement in the space, not just in what's happening in the global IT space, but the way in which Indian IT companies seem to be sort of hitting the limelight as well.
Absolutely, Surabhi. And you know what? The IT sector, I was just looking at it, has been one of the strongest performers this year, right? I mean, even if you look at large caps like Infosys, they're up 40% in 2020. Mid caps are doing exceptionally well. So the big question is, what do you buy now? Do you buy large caps? Do you buy mid caps? All of that will be discussed on our show, The Investment Guide. Okay, since today's focus is on the IT sector, COVID has resulted in an accelerated move towards digital transformation. But can that up move continue? First up, my colleague Rima is here to give us a quick take on the sector, and then we'll get a couple of guests on board. Rima, over to you.
Let's start by talking about some common IT terminology and how you value IT companies. The term you'll often hear about is constant currency revenue. What is that and why is that? Now, IT service providers get their incomes from various geographies. So to cut out the fluctuation in account of local currencies, it's best to review the earnings on a constant currency basis. Also, the non-seasonal nature of IT services require that we track the growth metrics on a quarter-on-quarter basis. And the valuation metric which is most commonly used is the PE multiple or price to earnings. So how has COVID changed the world for the IT industry? For one, there is an accelerated core digital transformation. And also this walk from anywhere is actually nudging the IT companies as well as the enterprises to accept higher outsourcing as well as offshoring. So the external environment is looking good for the IT companies, but can it result in higher growth rates? The chart over here will tell you that roughly IT companies had a growth rate of about high single digits from FY15 to FY20. On expected lines in FY21, we will see a decline, but thereafter it will be a V-shaped recovery. At least that's what Macquarie is predicting. Take a look at Infosys. Growth rate was 7 to 9% from FY16 to FY20, and that will accelerate to nearly 12% in FY23. And for HCL Technology, Macquarie is predicting that growth rates could hit 13.7%. The recent management commentary has also been fairly upbeat. If you remember, HCL Technology in its mid-quarter update has guided for a 3.5% revenue growth, margins at 20.5 to 21% higher than their earlier growth guidance, and across the board, the management commentary on the order book and pipeline has been exceedingly healthy. Moving on then to the margins. Q1 had the benefit on account of no salary increments, hiring freeze, lower travel costs. But if part of the cost saving can be structural, will it result in margins improving going ahead? The problem is that valuations are now much higher than their historical valuations. As you can see, it's across the board. So the big question is, are the IT sector valuations punchy, or is the IT sector recovery cyclical and structural? And if it is indeed structural, and if indeed IT companies are going to see higher growth rates going ahead, can it command higher valuations?
All right, Rima, thank you so much for explaining that to us and setting the context, really. Those are the big questions that we are going to take to the experts on the show as well. And joining us today are Mahesh Patil, Co-Chief Investment Officer at Aditya Birla Sun Life AMC, and Rahul Malhotra, Director, India Technology, Media and Internet at Bernstein. So we have someone who's been picking stocks in this area and someone who's been investing these companies in great depth and detail. Gentlemen, welcome to the show. Thank you for joining in. You know, Mahesh, I want to start with that big basic question. And by the way, Birla Sun Life has been running a digital fund, a technology fund, for 20 years. I thought it was a newer fund than that, but it's a 20-year-old fund. So Mahesh, you tell us, work from home, COVID, are we seeing a structural change or is this a passing trend?
So I think every crisis, what we see, there is a change in terms of technology adoption, which happens. And we've seen that post this crisis, many companies have tried to really move towards, there was a big transformation happening towards digital. And this has only accelerated that. And we've seen many top companies globally are actually trying to increase their spends, what they're trying to do, while the overall IT spends might not go up, but the allocation towards digital adoption and transformation is going to be a big change is what we see. And what Indian IT companies over the years, they were lagging behind in terms of digital. Okay, percentage of revenues coming from digital used to be pretty low at around 10%. That has slowly increased, now gone to as high as around 30, 40, even 50%. So there is increased share for them to really take of this spend, which is happening towards not only digital, but also towards cloud migration. And I think many companies are learning, especially after the COVID crisis, is that the BCP, they had BCP planning, but it's not as robust. And I think there's a new further investments, okay, which is going to happen over there. And that will also lead to better revenue for companies which are there in the infrastructure management space. And a couple of Indian companies are very strong in that area. So I would say that clearly the outlook for the IT sector, normally you would have thought after the crisis, one should see a slowdown in the sector because companies will be grappling for revenues and there will be a cost cutting. But that is only the initial reaction. But as we move forward and take next 1 or 2 year view, we're actually seeing that a lot of the companies are actually looking to increase the spend than what they would have done otherwise. And decisions are not being made by the IT heads. It's been driven by the front end. Okay, the sales heads, the business heads are actually driving the decisions in an effort to gain market share. And also in some cases, IT is a means to reduce cost as you automate more of your front end as well as back end. So I would see that it is a more steady change in terms of this thing. It's not kind of a cyclical uptick, but it should be probably more structural and sustain at least for the next couple of years.
Okay, so it's a structural move. That's what Mahesh Patil is saying. We have Rahul Malhotra of Bernstein as well. Rahul, you know, the big debate now is whether one should buy mid-caps or large caps, right? Do you think in this whole deep digital transformation exercise that we're seeing, do you think large caps stand to benefit more than mid-caps as far as execution capabilities are concerned? And what would your pick of the pack be?
Thanks, Sonia. So I think, Sonia, the way digital transformation is working, what we're seeing is that the deals are getting larger, and you know, our thesis is that the deals are becoming more integrated and end-to-end. That means we're seeing more billion-dollar deals in the recent times in the market. Clients really want to consolidate vendors across the larger vendors. They don't want a very long tail of vendors that are working with them. That means that the typical benefits of a vendor consolidation and this digital transformation towards integrated large deals, and it's across the front end, it's the middle end, as well as the back end cloud transformation. So we're seeing large caps actually gaining share in that play because, you know, they have the end-to-end capabilities. They can do front-end transformation, the CMO budget. They can work on the digital, the modernization of the legacy applications, as well as at the back end, the cloud transformation, working with the large cloud vendors like AWS, with Amazon, and Microsoft Azure. So I think the benefits of the digital transformation and the large deals and recent deals that have been announced, Infosys, Vanguard, TCS, Walgreens, all of these reflect the fact that the deals are becoming larger and much more integrated. And in that play, it's been harder for the mid-caps to participate because their typically value proposition has been the smaller deals, you know, typical $15, $20, $30 million deals. But as deals becomes $1 billion, it'll be harder for them to participate and from an end-to-end perspective on digital deals. And also beyond digital, I think what we are seeing is that a lot of the mid-caps have revenue concentration risk, which is, you know, top 10 clients are 45, 50% of revenues. And if in this environment, 1 or 2 clients start tapering down, you see material revenue declines. So I think from a both structural perspective, how digital transformation is kind of changing the landscape and becoming more end-to-end, and the kind of deals we are seeing in the market, I think it benefits the larger play who have pretty much a much full service kind of services offering for the clients, and as well as this trend to give pricing discounts, kind of give payment terms discounts in an environment of COVID, which I think the mid caps will not be able to compare with. So from our perspective, we believe both structurally and from a quality of business perspective, larger caps are well positioned. So I think there's a much more margin of safety today to look at larger caps and play the digital transformation story within that.
Okay, got that, Rahul. So that's a vote going in favor of large caps, a little more perhaps towards large caps than towards mid caps. We'll come down to some of the stocks that you track, some of the big bets as well in a bit from now. But let me ask you a more fundamental question first, Rahul. Now, a lot of these stocks and the large caps that you speak about, they've already rallied so much. They're sitting at, their 52-week highs. So then what's going to be the next big trigger for value creation, for PE expansion? Is it going to be top line growth? Is it going to be margins? What will drive further value?
Sure. I think the value of the valuation P multiples obviously are fairly high today, but I think they reflect the fact that the structural positioning of Indian IT services has strengthened over the years. We have seen them participate in much bigger from a large deal perspective. A lot of the clients today are giving out deals which are more integrated, where TCS, Infosys, HCL are well positioned. You're also seeing that the recovery is much stronger than anticipated. It's pretty much looking like a Q1 weakness, which will start recovering very quickly in Q2. And most of our numbers for FY22 are significantly high double-digit growth at very sustainable and consistent steady margins. So I think from that perspective, we still see that from a valuation perspective, there is some more headroom for PE expansion. I think from a quality of business perspective in this environment, a industry which is growing double-digit, which has steady margins, very strong free cash flow generation, a very strong dividend yield, tends to be a sector which is preferred. There's hardly any debt on these businesses, and also they are not a derivative of the Indian GDP, which could be weaker going forward. They are driven by the global tech rally and the global tech investments from entire Fortune 500 companies. So I think from that perspective, we think that the multiples are expanded to show that the quality in these businesses and their ability and the structural shift that's happening from all their ability to from a higher outsourcing perspective, as well as we see from our channel checks, a lot of clients are thinking about rebadging more employees, outsourcing in a bigger way. So I think there's a big structural shift that you will see going into next year. And the recovery is playing out fairly quickly. In 1 quarter's time, we start seeing sequential growth as HCL has come out, Infosys come out with very strong commentary. So I think there is all of those are reflecting to the fact and the quality of the business that the multiples have expanded, and there is still scope for further expansion because of their ability to continue gaining market share in the market. We see around $30 to $40 billion of renewal deals this year, and considering their positioning, I think Indian IT is well positioned to have a much higher win rate than history. So I think that all of those structural factors reflect the fact that there is still some headroom for multiple expansion.
Okay, Mahesh, I want you to come in on this. A very interesting point that Rahul has made, and I don't think too many viewers or investors know this. The valuations of mid-cap IT companies are much more expensive than large-cap IT companies. So, these points will come up. L&T Infotech, Mindtree, for example, trading at 19 times, while Tech Mahindra, HCL Tech at 14, 15 times. Do you think even on a valuation parameter, it's, the risk-reward is more favorable to buy large caps than mid-caps now?
Okay, the question is to me?
Yes, Mahesh, for you.
Yeah. No, I think, I think there is value or whatever opportunities there, both on the large cap space as well as the mid cap space. I would agree with Rahul that large cap offers much more margin of safety, much more stability, and much more visibility, because the way things are shaping up and in terms of consolidation which is happening, and able to provide end-to-end solutions, I think the large cap companies are much better placed over there. But I think in the mid-cap space also, I think there are niche companies, which are focusing in a particular domain. For example, very high on the technology, digital transformation, companies which are more platform-based or offering products, or even in the engineering services, I think where they are very strong. And I think we see that in the mid-cap space, until a company reaches a particular threshold size, if they are very strong at technology and in delivery, they can actually grow at a much faster pace. While the large cap IT companies will grow at, say, around high single digits or in the low teens, we could see some of the mid cap companies actually growing at a much higher pace. And that, I think, is clear differentiation. I think what is going to happen in the mid cap sector, companies which are having a decent visibility of growth, a higher growth, say in the mid teens or so, will tend to get a slightly higher multiple. And that's what we have seen the re-rating happen in the last 1 month or so. So we are actually pretty well, we are agnostic, okay, though our preference is for large cap. Our endeavor is to always look at some of these mid caps in the sector which are undervalued still, and which could probably surprise in terms of their top line and earnings growth. And that's where one can get the extra returns. So in our Digital India Fund also, we've got a decent exposure to mid caps, which have done well for us in the last 6 months. And that's one of the primary reasons for us to really outperform the benchmark in the last 1 year and 3 years by a significant margin.
Oh, yeah, and I guess you guys have been increasing your allocations as well, loading up during the market fall earlier this year. Well, gentlemen, we do have to take a break, so stay on. And our viewers, don't go anywhere because more questions are coming up with both Mahesh Patil and Rahul Malhotra. We're talking technology.
Welcome back. You're still watching Investment Guide on CNBC TV 18, where we're doing a deep dive into the IT sector. In fact, we have a couple of guests joining in who are telling us how to approach this space despite the rally that we've seen. Mahesh Patil of Aditya Birla Sun Life, AMC, and Rahul Malhotra of Bernstein are speaking with us. So let me just try and drill it down to the specifics. For a viewer watching us right now, Rahul, I want you to answer this question. What are the important financial ratios that one needs to track? I mean, our colleague Rima was just telling us about the key parameters. But from your end, when you pick a company in the IT space, what are the important ratios?
Sure, thanks, Sonia. So I think the key ratios, obviously, growth margins and the balance sheet. And growth, I think a key factor that a lot of these companies have started giving out is their total contract value in a quarter. And that's been a good kind of view of how their ability to win large deals with their clients is evolving. And TCS has been giving out for last few quarters. Infosys gives out that number. And we've seen that growing significantly. TCS was close to 28 billion this year with 8-9 billion the quarter. Infosys large deals also has been expanding. So I think that is one metric that we track quickly, closely to look at how is the deal momentum playing out, because a lot of the growth is driven by large deals. And I think on the growth, revenue growth, as the constant currency, both sequential quarter on quarter and year on year are key factors. We also look at growth by verticals. So constant currency growth across verticals kind of gives out the fact of whether the growth is stronger in one vertical versus the other, or it's more balanced growth across banking, financial services, retail, telecom, consumer products. So I think those growth parameters are imperative to look at the quality of growth that's coming out. And I think on the margin side, EBIT percentage margins is important to look at, particularly because that reflects the fact that is a company going through more pricing pressure if margin starts dipping quarter on quarter, or there is more stability where they're using their operating efficiencies of on-site offshore ratios or utilization of fixed price projects to manage their margins. So I think the growth side, the EBIT margin, and finally the free cash flow conversion. How much, because these are high dividend yield businesses, typically free cash flow conversion shows the quality of their balance sheet. So if the free cash flow conversion is close to 90 to 100% of net income, that reflects a fairly strong balance sheet and conversion ratios, which obviously goes down for high ROCs in the business. So I think those 4 or 5 on growth, margins, and then ROC and free cash flow conversion are the key metrics to look at once you look at IT services performance.
Okay, great. That sort of gives investors a benchmark to work with and some of the key ratios to look at. Mahesh, I was doing some studying last night. I was looking at your portfolios, and what I figured were a couple of things. One, that technology is among the top 3 sectors in terms of exposure. across most of your funds. I mean, the large cap, even the focused equity. And then I was looking at your Digital India fund, which is managed by Kunal. And surprise, surprise, Apple. You have exposure to Apple. I know you won't get into individual holdings and stocks, but that brings me to a larger question, right? Indians now want to play technology, and they're asking if it's just better to invest in some of these offshore US funds rather than an India-specific IT fund. What would you say to that debate?
Well, that's true, actually. In the last 2-3 years, we started looking at global companies, and more so in the technology space, right? Because that's an area where we've got a lot of these large global companies which are there. And they are, I mean, for the typical IT outsourcing kind of business, I think Indian IT companies actually suit the bill. You can play that too. But there are, I mean, IT is not just to us outsourcing, right? It's much more than that. And there are global companies which are platform companies. There are product companies which are there globally, which we think offer good upside, okay, because they're catering not only the US market, but to the global marketplace, right? And have shown a very steady growth over many years. So I think with that objective and to diversify our positioning and essentially to play a certain spectrum of the technology space, which you can't really play through our listed space, we decided to look at some of these names. So we have players, companies like Apple, for example, Microsoft, which we have. Again, there are various reasons which we have brought into some of these names. Some of these companies are product companies, for consumer-oriented companies, and again, the common theme underlying some of these names are they are the technology leaders in their space, they are innovators in that space, and they are continuously investing their capital into innovation, to R&D, and ensuring that they are coming up with new products, which will enable to sustain the kind of growth what they have shown in the past. So I think that's helped us actually to diversify the portfolio. And while there is still a correlation between domestic IT companies and global IT, in fact, we see that the recent valuation multiple re-rating what we have seen in the domestic names is mainly to do with the rally what we have seen globally. But there are niche companies which are there globally which are not so much dependent, purely on the outsourcing business. And at times we also see there is a lot of noise which happens, especially during the US elections about outsourcing on visa restrictions. And at that times it makes sense to really have some exposure in some of the global names which, while the underlying fundamentals remain the same, I think they're not too much impacted by that. So we've seen this diversification really has helped us, and we have made a beginning over there, but idea is to really have a much larger ownership there, at least around 20% of our portfolio to some of these large leading global IT names.
All right, we're actually running out of time. It's a very enriching conversation, but let's leave our viewers with some IT bets, right? So Rahul, tell us, what are your top IT bets? Which are the companies that you like the most, say from a 1 to 2 year horizon now?
So for us, our top pick is TCS, Tata Consulting Services. And I think from the digital transformation journey that's playing out for all of these companies, I think TCS, because of its full service positioning, a very platform approach, is well positioned to take a lot of share from these large deals coming in. And also TCS has the ability to keep the margins much more steady. They maintain the margin in the 25-26% EBIT range for a longer time. So from our perspective, we like the strength of the business model, the ability to maintain growth and win some of the very strong large deals in the market that will come in the near future as well, and then maintain very strong margins and deliver best-in-class free cash flow. So TCS for us is our top pick.
Okay, all right, gentlemen, we have completely run out of time. Not questions, but time, yes. Thank you very much for being with us and giving us your perspective and some thoughts on all about the IT space and how things are evolving over here. So Very, very interesting trends coming in, Sonia, from FANGs in the US to our own homegrown companies. Technology seems to be here to stay in the investment horizon.
And I think we've become wiser, right? We know all the ratios that you need to track. We know all the valuations right now. So it was an IT 101 lesson that we got from both our experts in the last half an hour. With that, it is curtains down on this edition of Investment Guide. We will be back same time, same place next week to talk about a deep dive into another sector. Thanks for watching.